What if I told you that everything you think you know about investing is probably wrong? What if the secret to building wealth wasn't about picking hot stocks or timing the market, but about doing the exact opposite of what most investors do? Today, we're diving deep into John Bogle's revolutionary investment philosophy that turned Wall Street on its head and created billions in wealth for ordinary investors. John Bogle didn't just write a book about investing, he literally invented an entirely new way to invest that saved investors trillions of dollars in fees while delivering better returns than most professional fund managers. This man founded Vanguard, created the first index fund, and spent his entire career fighting against an industry that was designed to extract money from your pocket. The little book of common sense investing isn't just financial advice, it's a declaration of war against the mutual fund industry's greed. But here's what makes this story incredible. Bogle was actually fired from his own company before he revolutionized investing. He was considered a failure by many in the industry, yet his simple philosophy became so powerful that it forced the entire financial world to change. Warren Buffett calls him a hero. Academic researchers have proven his methods work, and millions of investors have become wealthy following his advice. Get ready to discover why complexity is the enemy of returns, why costs matter more than performance, and how a simple strategy that takes 5 minutes to implement can outperform hedge funds that employ PhD mathematicians. This isn't just about money, it's about taking control of your financial future and never being fooled by Wall Street again. The little book of common sense investing represents the distilled wisdom of one of history's most influential financial figures. John Bogle revolutionized investing by challenging every assumption the financial industry held sacred. When he published this book, he wasn't just sharing an investment advice, he was exposing decades of industry manipulation and offering a solution so simple that it seemed too good to be true. Bogle's credentials speak volumes about his authority on this subject. As the founder of Vanguard Group, he created the world's largest mutual fund company by assets. More importantly, he invented the index fund, a financial instrument that democratized investing and made it possible for ordinary people to achieve market returns without paying excessive fees. His company operates at cost, returning profits to investors rather than enriching shareholders, a radical departure from industry norms. This book emerged from Bogle's decades of battle against an industry he viewed as fundamentally corrupt. He witnessed firsthand how mutual fund companies enrich themselves at investors' expense through high fees, excessive trading, and marketing gimmicks. His frustration with these practices drove him to create a manifesto for rational investing that prioritizes investor interests over industry profits. What makes this book extraordinary is its timing and context. Published during an era of increasing financial complexity, when new investment products proliferated daily, Bogle advocated for radical simplicity. He argued that investors were being overwhelmed with choices that benefited sellers more than buyers. His solution cut through this complexity with surgical precision. The book's power lies in its mathematical foundation combined with moral clarity. Bogle doesn't just argue that index investing works better, he proves it with decades of data. Yet he also makes a compelling ethical case that the financial industry has a responsibility to serve investors rather than exploit them. This combination of rigorous analysis and passionate advocacy creates a compelling argument for fundamental change in how people invest. The central thesis of Bogle's work challenges the foundation of active investment management. He argues that the quest to beat the market is not just futile for most investors, but actually harmful to their long-term wealth accumulation. The book methodically dismantles the myths surrounding active investing while building a compelling case for passive index fund investing. Bogle's argument begins with a simple mathematical reality that most investors ignore. The stock market is a zero-sum game before costs, but a negative-sum game after costs. When investors collectively try to beat the market, they collectively become the market. The only certainty is that costs will reduce their returns. This fundamental truth drives everything else in the book. The author presents overwhelming evidence that mutual fund managers consistently fail to outperform simple market indexes over time. He analyses decades of performance data showing that the small percentage of funds that do beat the market in any given year rarely repeat their success. Even worse, investors consistently buy funds after good performance and sell after poor performance, further reducing their returns through poor timing. Bogle introduces readers to the concept of the relentless rules of humble arithmetic. These rules demonstrate how seemingly small fees compound over time to consume enormous portions of investor returns. A fund charging 2% annually doesn't just reduce returns by 2%. Over decades, it can consume 30 to 40% of total wealth accumulation through the power of compound costs. The book then presents Bogle's solution: broad market index funds that track the entire stock market at minimal cost. These funds don't try to beat the market, they become the market. By eliminating stock selection, market timing, and excessive fees, they capture the market's full return minus tiny administrative costs. This approach virtually guarantees that investors will outperform most actively managed funds over time. The book's foundational argument centers on what Bogle terms the relentless rules of humble arithmetic. This concept reveals how mathematics, not market genius, determines investment success. When the total stock market delivers 10% annual returns and your mutual fund charges 2% in fees, you don't simply earn 8%. The compounding effect of those fees creates devastating long-term consequences. Over 30 years, a 2% annual fee can reduce your final wealth by approximately 40%. Bogle demonstrates this with stark calculations showing how a $100,000 investment becomes worth dramatically different amounts based solely on fee structures. He argues that investors focus obsessively on fund performance while ignoring the one factor they can control: costs. The mutual fund industry performance failure represents another central pillar of Bogle's argument. He presents comprehensive data analysing mutual fund performance over multiple decades, revealing that approximately 80% of actively managed funds fail to beat simple market indexes over long periods. Even more damaging, the funds that do outperform rarely sustain their success. Bogle examines survivorship bias, showing how failed funds disappear from databases, artificially inflating industry performance statistics. He also analyses fund manager tenure, revealing that successful managers often leave to start their own firms, taking their talent away from existing shareholders who invested based on past performance. Bogle's creation of the first index fund in 1975 marks a pivotal moment in investment history. Initially derided as Bogle's folly, the fund was designed to simply match market performance rather than beat it. The concept seemed so radical that major Wall Street firms predicted its certain failure. They argued that investors would never accept mediocre returns when superior performance seemed available elsewhere. However, Bogle's mathematical analysis suggested that capturing market returns minus minimal fees would outperform most actively managed alternatives. The fund's subsequent success validated his theory and launched a revolution that transformed the industry. The cost structure comparison between active and passive investing forms another crucial element of Bogle's thesis. He meticulously dissects mutual fund expense ratios, showing how seemingly small percentage differences create enormous wealth disparities over time. Beyond annual fees, he exposes hidden costs, including trading expenses, tax inefficiency, and cash drag from maintaining reserves. Active funds might show expense ratios of 1 to 2%, but their total cost of ownership often reaches 3 to 4% annually. Index funds, by contrast, can operate with total costs below 20 basis points, creating a massive mathematical advantage that compounds relentlessly. Bogle's analysis of market timing and stock selection reveals the futility of these popular investment strategies. He presents research showing that even professional money managers with access to sophisticated research and trading systems cannot consistently predict market movements or identify undervalued securities. The book examines famous market timing failures, including mutual fund managers who moved to cash before market rallies and loaded up on stocks before crashes. Similarly, he analyses stock picking performance, showing how diversification dilutes the impact of successful selections while concentration amplifies the damage from mistakes. The behavioral psychology of investing receives significant attention as Bogle explains why investors consistently make poor decisions. He documents how emotions drive investment choices, causing people to buy high during market euphoria and sell low during panic. The mutual fund industry exploits these tendencies by marketing funds with stellar recent performance, knowing that investors will chase yesterday's winners. Bogle presents data showing that investor returns consistently lag fund returns because of poor timing decisions. Even when funds perform well, their shareholders often experience mediocre results because they enter and exit at wrong times. Tax efficiency emerges as another advantage of index investing that Bogle emphasizes throughout his analysis. Active funds generate substantial taxable distributions through frequent trading, forcing investors to pay taxes on gains they never realized. Index funds trade infrequently, allowing investments to compound without tax interference. Bogle calculates that tax efficiency can add 1 to 2% annually to after-tax returns, creating another mathematical advantage that compounds over decades. This benefit particularly impacts investors in higher tax brackets and those investing in taxable accounts. The book concludes with Bogle's vision for industry reform, where he argues that fiduciary duty should require investment managers to put client interests first. He proposes structural changes, including fee transparency, performance reporting that includes all costs, and governance reforms that align manager incentives with investor outcomes. Bogle envisions an industry focused on delivering market returns at minimal cost rather than gathering assets through marketing and fee extraction. His advocacy helped spawn regulatory changes that improved disclosure requirements and reduced some industry abuses. Investment costs represent the single most important factor determining long-term wealth accumulation, yet most investors completely ignore them. Bogle's research demonstrates that a mutual fund charging 2.5% annually will consume approximately 2/3 of your potential wealth over 40 years compared to a fund charging 0.25%. This isn't speculation, it's mathematical certainty. Every additional percentage point in fees requires your investments to generate higher returns just to break even. Since no one can predict which funds will outperform, controlling costs becomes the only reliable strategy for improving outcomes. Smart investors obsess over expense ratios the same way smart shoppers compare prices. Diversification provides the closest thing to a free lunch in investing, but only when properly implemented. Most investors think they're diversified because they own multiple mutual funds, but they often hold similar stocks with overlapping strategies. True diversification means owning the entire market through broad index funds that include thousands of companies across all sectors and sizes. This eliminates the devastating risk that poor stock selection or sector concentration will destroy your wealth. When you own everything, you can't be wrong about what will outperform because you automatically own whatever performs best. Time represents your most powerful investing weapon, but only if you avoid major mistakes that interrupt compound growth. Bogle emphasizes that investment success isn't about timing the market or picking winners. It's about consistently investing over decades without interruption. Every dollar you invest at age 25 becomes $16 by age 65 at historical market returns. However, this only works if you avoid panic selling during market downturns or chasing performance during bull markets. The investors who become wealthy are those who stay invested through every market cycle. Market timing appears profitable in theory, but proves impossible in practice, even for professional money managers with unlimited resources. Bogle presents data showing that successful market timing requires you to be right twice, when to sell and when to buy back. The mathematical probability of consistent success approaches zero when you account for transaction costs and taxes. Even perfect timing of major market peaks and valleys adds surprisingly little to long-term returns compared to simply staying invested. The opportunity cost of missing just a few of the market's best days can devastate decades of wealth accumulation. The mutual fund industry's marketing machine deliberately exploits investor psychology to generate profits rather than returns. Fund companies spend billions advertising their top-performing funds while quietly closing or merging their failures. They know investors will chase recent performance despite overwhelming evidence that past success doesn't predict future results. Bogle reveals how survivorship bias inflates industry statistics by removing failed funds from databases. Smart investors ignore marketing materials and focus on fund structure, costs, and long-term consistency rather than short-term performance rankings. Tax efficiency can add 1 to 2% annually to your returns through simple fund selection, yet most investors ignore this massive opportunity. Active mutual funds generate substantial taxable distributions through frequent trading, forcing you to pay taxes on gains you never received. Index funds rarely distribute capital gains because they trade infrequently, allowing your investments to compound tax-free until you sell. This advantage particularly benefits investors in high tax brackets and those investing outside retirement accounts. Over decades, tax efficiency can increase wealth by hundreds of thousands of dollars. Behavioral mistakes consistently destroy more wealth than market volatility, making investor psychology more important than investment selection. Bogle documents how investors systematically buy high during market euphoria and sell low during panics, turning market volatility into permanent losses. The solution isn't better market predictions, it's removing emotions from investment decisions through automatic investing and disciplined rebalancing. The most successful investors are often those who check their accounts least frequently and make the fewest changes to their portfolios. Simplicity beats complexity in investing because complex strategies provide more opportunities for mistakes and higher costs without improving returns. The financial industry promotes complex products because they justify higher fees and create switching costs that trap investors. Bogle advocates for portfolio strategies so simple that they require minimal maintenance and can be easily understood. A simple 3-fund portfolio holding domestic stocks, international stocks, and bonds can capture global market returns while minimizing costs and complexity. Rebalancing forces you to buy low and sell high automatically, but only if you resist the temptation to make emotional adjustments. As asset classes perform differently over time, your portfolio will drift from your target allocation. Systematic rebalancing sells what has performed well and buys what has performed poorly, capturing the mathematical advantage of mean reversion. However, this only works if you stick to predetermined schedules and percentages rather than making emotional adjustments based on market predictions. The compound effect of small advantages creates enormous wealth differences over investing lifetimes, making seemingly minor decisions incredibly important. Reducing investment costs by 1% annually might seem insignificant, but it can increase lifetime wealth by hundreds of thousands of dollars. Similarly, starting to invest just 5 years earlier can add more to retirement wealth than doubling contribution amounts later in life. These mathematical realities mean that young investors should prioritize time in the market and cost control over complex strategies or performance chasing. John Bogle's The Little Book of Common Sense Investing stands as more than an investment guide. It represents a moral crusade against an industry that prioritizes profits over people. His simple yet revolutionary message transformed how millions of investors approach wealth building and forced the entire financial industry to reckon with decades of exploitative practices. The book's enduring power lies in its combination of mathematical rigor and ethical clarity. Bogle's legacy extends far beyond the pages of this book. His invention of the index fund democratized investing, making it possible for ordinary people to capture market returns without paying excessive fees to Wall Street intermediaries. Today, trillions of dollars flow through index funds, saving investors hundreds of billions in fees while delivering superior returns. This transformation didn't happen through marketing or salesmanship. It happened because mathematics proved Bogle's theories correct. The book's relevance has only increased as financial markets become more complex and expensive. New investment products emerge constantly, each promising superior returns while charging higher fees. Bogle's simple framework helps investors cut through this noise by focusing on the only factors they can control: costs, diversification, and time. His approach doesn't require special knowledge, perfect timing, or expensive advice. It simply requires discipline and patience. Perhaps most importantly, Bogle's work reminds us that investing success isn't about beating others. It's about reaching your financial goals. The market provides sufficient returns for anyone willing to capture them through low-cost diversification. You don't need to outsmart Wall Street professionals or predict economic trends. You just need to own businesses, keep costs low, and stay invested for the long term. In a world obsessed with complexity and quick profits, this simple wisdom continues to create wealth for those smart enough to embrace it.